Hello everyone. Hopefully after holidays you have more time and desire to learn something new. It's Sergey here, and we are going to have a practice related to our dive into costs and inventories and QuickBooks and a bit of revenue recognition, a bit of work on our accounting memo. If you have any preferences where to start, so a Q&A session is for those who come to the session. So if you have any preferences, or if you want to me to look at any particular problem of your interest, please let me know via the chat, and we will shift our attention there. So let's open our homeworks for today. I see we have someone online, but not that many people. Okay, so here is a link to the homework. We had 5 new entries for business, which you are doing on your own now. I'm not going into that unless you specifically ask me to. Then we have a task to use SUMIFS to create additional columns on trial balance to have our balance sheets and income statements for multiple periods, so that we can distinguish periods in our trial balance sheet and income statement. Let's see what I have here. Okay, in my trial balance I have different periods for income statement, but no different periods for balance sheet. So I will do that right now, and you will be able to repeat that in your files. Let's see. Let me know by the way if there are any sound issues or any video quality issues. So far it looks okay for me. Let me just try to reopen and look on translation externally. Can I pick higher quality? Yeah, I can pick 720p, which looks reasonable for our needs. Okay, so multiple periods in the balance sheet. What you can remember from earlier lectures, income statement accounts are periodical accounts. So at the end of every period, you kind of you clean the income statement accounts through retained earnings to the balance sheet. Like you calculate net income here, and you move that net income to the balance sheet to retained earnings, to equity section, to retained earnings within equity section. Then you calculate the next period here, and you add these retained earnings to what you have there, and you accumulate retained earnings. And you start for the income statement, each period you start from scratch, and the period is usually 1 month. Okay, so we accumulate the months in the income statements, and then our annual income statement, or quarterly. So quarterly income statement is the sum of 3 months, and annual income statement is the sum of 12 months. And the things are different with the balance sheet. In the balance sheet, you accumulate your transactions during like many years, since the day one of your company. So let's see. Let's go here. Okay, period 1. I believe we can use the same formula. So by using that formula, we should get to, let's see, how do I get retained earnings here? Okay, so that's owner's draw. So on the trial balance, our retained earnings are not closed. Our retained earnings on the trial balance is the cumulative effect of our income statement. So we accumulate our income statement. So that's how our trial balance is equal to 0 if we sum up all the debits and credits in the trial balance. Okay, and we have all the rights to make our check through all the accounting periods which we have here. Okay, and it looks like our balance sheets work for the period 1. I used SUMIFS function to make all of that work. I will demonstrate quickly how does it work. So SUMIFS is a great function. So we do SUMIFS, then we should to go to our transactions list and select the column with numbers which we want to SUMIF. Then we put in a comma, and then we should go and select the criteria. So the first criteria will be account name, and then we go back to the trial balance and select account name. Then I put in comma, and I go to transaction list again and I select period. Then I put comma again and I go back to trial balance and select period 2 in our case. So that works for us. And let's do some check here. One more check. So accounting work is full of checks. So I start with this total and I deduct the sum of the periods from the total. So cumulative, it just SUMIFs all the numbers. It disregards the periods in the balance sheet. Just SUMIF function. So we skip the period in that formula. So it just SUMIF all the periods, which is okay for the balance sheet. And for periods, we pick each exact period. And now, if we want this formula to move correctly, to be able to copy it correctly, you see it doesn't work for other numbers, because when we go, that criteria moves, the period criteria. In order to avoid that, we use the dollar signs. So we do not want this cell G2 in the formula to change number 2, row number 2. We do not want it to change when we copy formula. So I add a dollar sign. And also we would like to copy that formula to the period 3. And if I do that, my selection of the cash account goes bad. So it goes to the different account. In order to avoid that, so cash is C4, so it's here. I want cash to change the row number, but I don't want it to change the column name. So I put dollar sign to the C. Okay. For those who are not new for the course, sorry for repeating all of that. I think we will be done with the SUMIF after that module. So I basically put it all here. Okay, so it looks like, let's see, do I have anything allocated? So I see we have Svetlana online. Svetlana, do you want me to look at some of your homework? Do you need help with something? And I also add all of that. Okay, it seems I don't have period 3 here, but let's see. So my last period in that was period 2, and the balance sheet, it exists as of some date. So my period 2, because it was my last period, my cash at the end of the period 2 should equal my cumulative cash. And as you can see, it only accumulates that way. So in order to make my balance sheet right, I need to add period 1 balance sheet. So that should be number 4. I need to add my period 1 balance sheet to whatever I submit for the period 2. So my last period available balance sheet should be the same as a cumulative balance sheet. And that check should actually look different. It should be my cumulative balance sheet minus my last available balance sheet. So what is that? Why is it different? 3,000, 2,000. I have that part here, but it doesn't sum. So let's see. Okay. How is that possible? Let's see and find out. So I will pick up numbers here and I would remove periods here. Yeah, so I have couple transactions without period, so I can allocate this to period 3. And now our last period is period 3. For some reason it still doesn't want to work. Let's go back here. No, period 3 should work. And accounts and have correct names. Okay, let's go back to trial balance. Yeah, I probably need to look more into that. So I SUMIFS from column F, accounts receivable, revenue, services. So it's all from trial balance. C19. Yes. How is it possible? Svetlana, regarding your question about advertising. So usually advertising is you just call the expense an advertising expense, and you usually allocate it to selling, general and administrative expense. But depending on the circumstances, for example, if you are engaged in some kind of affiliate marketing, like when you sell some informational products or SaaS services, and you have affiliates who sell it for you and then charge you some commission for that, that might be as well part of your cost of sales. But most of the time, if it's straight like advertising, then you usually charge it to selling, general and administrative expense. But if you are an advertising agency and you sell some advertising services, no, you do not, you mean, can we capitalize it as a cost of inventory? Капитализировать на стоимость запасов или в себестоимость? So I would say that advertising is not capitalizable. Let's make a quick check. We have inventory. So whatever we can capitalize on inventory, it can be added. Is your question about revenue or cost of sales? So cost of sales, whatever we can capitalize on the inventory, we can include that in the cost of sales. So let's take a look. It's a good question. Let's see if I can. Where is the PDF? So in the inventory guidance here, and I'm sharing the link. Oops, not the right one. Okay, so if the guidance says that you can include that so like here they have a big list of whatever can be included in the cost of inventories. Cost of quality, rework, so scrap and theft not includable, vendor rebates, depreciation, repairs, maintenance, utilities, rent, bidding cost not included, engineering can be included, can be not included. Marketing, advertising and selling expenses, not usually inventoriable costs. So in most of the situation, marketing, advertising and selling expenses will not be capitalized to the cost of inventory and will be part of general selling and administrative expenses. In certain circumstances, especially if you are selling some marketing and advertising services, or maybe some products, some complex products related to marketing and advertising, you can come up with a situation when you can include advertising in the cost of sales. I cannot imagine now a situation when you can capitalize advertising to the cost of inventory. Maybe if anyone else can imagine such situation, then we can discuss that. But overall, marketing, advertising and selling expenses is not includable, not an inventoriable costs. Okay, let's come back to period 3. I have no idea why doesn't it work. So it should, let's see what I put. Accounting period 3, trade receivables, revenue services, column FF. Okay, I know what happened. Not only criteria, I should have also fixed my columns here. It's done with A4, just put $signs to every column. So that's where my error was for these formulas. Spreadsheet is a great tool. Okay, so we sum up here and income statement. Okay, let's see. We still got 4,000. Let's run a check. We should run it on period 3 now, because our cumulative should equal to period 3. Okay, no, it doesn't show any errors or omissions. Still balance sheet doesn't balance, and something is obviously wrong in period 2. So what can that be? So our transactions sum to 0. We probably have some accounts missing from. I have some special check for that. Let me run a check for all the periods. So the more complex the situation gets, the harder it is to use a spreadsheet. And you need to be very well disciplined to use spreadsheets. No, everything is here. So at this point, I don't have an idea how to manage that. So I will take some time till next Q&A to see if I can fix it. Anyone on the lesson today who wants their homework to be looked at? For the balance sheet, for income statement, period 2 is totally separate from period 1. Okay, so what we have here? Okay, it shouldn't be here. Your question is well timed, Svetlana. For income statement, we shouldn't include what? Okay, so here's where we get an error. We need to add retained earnings here and here. Yeah, it is a bit more complicated. Your question, Svetlana, helped me with a solution to the problem. Okay, so now everything is 0. About inclusion of the periods. So each income statement for period, income statement is periodic. And we do not include other periods into income statements. So period 3, we have just 2 transactions. We have a lot of transactions here, not much here. So this is each period separately. For the balance sheet, our balance sheet as of the end of each respective period is like a cumulative history of all transactions on that balance sheet account. So our cumulative cash, our period 3 ending cash, will be our period 1 cash balance plus whatever happens in the period 2 plus whatever happens in the period 3. But not, you cannot just add 3 periods. You actually take period 1, so end of period 1 is $12,000. And if you go back to transaction list and select cash, Russian language. So we select cash. Okay, so at the end of our third period, we have periods here. So our cash at the end of the third period will be all our cash. We actually do not have cash transaction in the third period, but our cash balance as of the end of the period 2 will be the sum of period 1 transactions and period 2 transactions. But because the SUMIFS function SUMIFS only period 2, we also need to add period 1 balance there. So this is 12,000. This is 12,000 here. So if we go to trial balance, we will see 12,000 here. If we just SUMIFS period 2, we will get 415,000. But we should have gotten 427, which is 415,000 plus 12,000. That's because of the nature of the balance sheet transactions. Balance sheet transactions are cumulative, and with SUMIFS, you only SUMIFS transactions related to period 2. That works quite good for your income statement, but that doesn't work good for your balance sheet. You need to have your balance sheet at the end of each period, and those balances, cumulative balances, they will include your previous period plus your activity during period 3. That's why I have that plus here. I saw Irene did something here, and she has period, for some reason there is period 3. Let's see if, okay, so it's still not balancing. So let's see what she have here. Okay, it's a bit complicated. She has net profit. So in order for that to balance, we need to add a retained earnings here. But it wasn't balancing in the first place. So if Irene is here, you can ask me to try to fix your homework. If not, you can come to Saturday Q&A and ask me to do that, or maybe any other Q&A, one of the next Q&As. Okay, so let's see what else do we have for today. We have QuickBooks transactions. We have QuickBooks transactions on prepaid revenue. I did a video on that. Unfortunately, there is pretty bad functionality in QuickBooks for prepaid revenue. Probably QuickBooks Online is targeted on small businesses, and small businesses do not have much of prepaid revenue, or they just do not care to use accrual basis for prepaid revenue, and they just recognize the revenue when they get cash. So there is no good functionality in QuickBooks for prepaid revenue. There is only like a workaround. Let's see what we have here. Does anyone have questions about prepaid revenue? If not, there is a video on my channel, and you can also find other videos about that. Customer prepayment, copy link address, prepayment, QuickBooks Online. Okay, so I will not spend much time. We can remember from our previous homeworks, from our tax memo, that we have, depending on our policies and depending on the basis which we use for taxes to report taxes, the prepaid revenue can either have or have no effect on the moment when we pay taxes. If we use cash basis for taxation, if we report our taxes on the cash basis, we will recognize income when we receive the cash, not when we actually should recognize revenue. When we will recognize earlier when we receive cash. If we are under tax accrual method, we actually have a choice to either recognize when we get prepayment or to use accrual basis. Basically, when to recognize taxable income when we recognize revenue. You can review one of the previous sessions about that topic. Let's see. Prepaid expense. So I did a customer prepayment here, and I will provide prepaid expense topic later today. Okay, I've provided link to the homework. I will just double check it. Okay, so just in case, so just you just have it. So on the prepaid expense, I will do that video later. I believe prepaid expense will have the same workaround in the QuickBooks as we did with prepaid revenue. So you will basically need to create like a separate products with separate billing, with a separate how to say it, account allocations option. So you need to kind of buy an imaginary product, buy a dummy product where you would book the product not to not to revenue account. You would book the proceeds not to revenue account but to liability account in case of customer prepaids. And in case of vendor prepaids, I would assume you do vice versa. You will do your cash outflow. You will not debit an expense. You will debit a prepayment. But we do not have like a prepayment option here. Oh. Is everything okay? Sound okay? Quality okay? I'm getting messages that something is wrong with the translation. Okay, let's move on. Cash revenue, cash expense. It's basically the simplest option. You recognize revenue and expense and cash moves at the same time, and for the taxation purposes you also recognize under both methods, under cash method and under revenue method, you recognize everything in the same moment. So that's basically the easiest way to do things. And QuickBooks is mostly built for the QuickBooks Online. QuickBooks Desktop has some like extra features and it costs more money. But QuickBooks Online is built for the businesses which use that functionality. Okay, that one directly relates to our last lectures about inventory valuation and about cost of sales. On the last lecture, we reviewed the inventory guidance, and we also did some exercises about inventory valuation and cost of sales. For this lecture, I did a bit of a extension to the exercise. Let me just find it. IRS cost of goods sold. So for some taxpayers, for some business taxpayers, IRS cost of goods in that situation, Here is an excerpt from Schedule C. So Schedule C is a part of your tax return for business, and part of that Schedule C is figuring out your cost of sales. And in that respect, the formula which IRS use is pretty close to the one which you would see in financial accounting and in accounting in general. So you start from some inventory at the beginning of the year. You enter your purchases for the year. You allocate some labor to the inventories. You actually need to know some cost accounting. It's a separate discipline. You need to know some cost accounting to be able to allocate amounts properly. You allocate some materials. So all these allocations, if you take a closer look, all these allocations from the IRS are basically the same which we have in the inventory guide. So if you scroll down, utilities, rent, cost of indirect materials, equipment capitalized, labor, and so on. Let's see, does IRS has an equipment capitalized? It has other costs, but I would say that depreciation should also be capitalized here, unless I will retract this statement. I cannot remember right now if because IRS has its own depreciation schedules, and I would assume one would adjust inventory cost, but I will check it. Let's see if I have. Do I have link to Q&A file? I will just go to my Q&A file and put myself a reminder to check on whether depreciation is included in inventory valuation for IRS purposes. And I didn't accounts receivable for doubtful allowance. Okay. Okay, I need to check on that. Okay, other costs, let's say 4,000, and we add the lines and then we have some closing inventory. Let me make it okay, let's assume we fill in the return for IRS, and let's say we are left with a 10,000 of inventory. So our cost of goods sold would be whatever we spent on the inventory, including opening inventory, less whatever is left. And let's do a couple of challenging questions here. So what we can ask about first number? Was it calculated directly properly? Is it the same as closing inventory in prior year? So basically for the opening inventory, we need to know that whether it was calculated correctly and whether we used the same on the year before this year, whether our inventory at the year end was that number. So that's what we know, what we need to know. Purchases. So we have a personal use item, so it's obvious here that we do not need to include the personal use items, but otherwise purchases seems like just the number we can get from from our accounting records. Cost of labor. How do we basically, just a note here, there might be some labor. Let's say it, how do we separate cost of sales from general, from, let's call it SG&A. Materials and supplies. Again, some materials and supply might go to SG&A. It's not a big deal, I would say, but still, let's say it here. Okay, so that is HMAS. And the last and very important question is, how do we value that inventory? And I would say that that question is probably 50% of the work and 50% of the guidance, of the tax guidance which we would use. Is there any question about the formula? Is it clear? Is the formula clear? So formula is to calculate cost of goods sold in the period. Obviously, whatever we have at the end of the period is not sold, was not sold, so shouldn't be included. Let's assume our closing costs was 0. Let's assume that we sold everything. In that case, our cost of goods sold would be just whatever we have at the beginning, plus purchases, plus cost of labor, plus materials, plus other costs. So all of that would total to 40,000, and that would be our sales. Let me check the time. Okay, 9:42. So that's how cost of sales roll forward works in accounting and in IRS. So the main question, I would say, is how do we value inventory here? Okay, and regarding our homework, we have inventory loss quantity wise, and we also have inventory NRV adjustment or inventory loss quality wise. Let me copy. Okay. Inventory costing video. Here is a fresh video. Oh, sorry. That's the video. Okay. Now I copied some guidance from the IRS for these two methods. In our homework, we have a transaction to record inventory loss. Again, I did a separate video on that. To record the loss in quantity, only in quantity, there is a special function in the QuickBooks, inventory quantity adjustment. And when you record that, let's say we got bushes and we want to record some more, another loss of 10, and you can choose the account where you will book the inventory loss, and you just save it, and then you can delete it. So quantity adjustment is pretty easy. Quality adjustment is not easy, and or NRV adjustment, the situation where your inventory loses value. But let's go back for IRS for a minute. IRS publication. I believe this would be publication 538, accounting periods and methods. For some reason they included inventories here. And for the inventories, first of all, we have a provision for goods that cannot be sold. There are goods that you cannot sell at normal prices, or they are unusable in the usual way because of damage, imperfection, shop wear, and so on. You should value these goods as their bona fide selling price minus direct costs of disposition, no matter which method you use to value the rest of your inventory. If these goods consist of raw materials or partly finished goods held for user consumption, you must value them on a reasonable basis. So basically what they say, if you have losses, if your inventory lost its qualities and you cannot sell it at normal prices, you cannot sell it at profit because of that spoilage, you need to write off. You need to write off it to the amount at which you can reasonably sell it, less the disposition cost. So eventually you can write down your inventory to zero if it doesn't even have a scrap value. If it has a scrap value, you need to use scrap value, unless you can sell it for higher than scrap value. So that's a good to know. That's good to know that you can actually, if you do a year-end inventory count, you can determine which items you cannot sell at profit, which items lost value, and you can write down those items. Number 2, let's see, loss of inventory. So you might have a situation when you lost inventory, and obviously you can claim that as a business expense if you lost inventory. The only situation which you need to look for is that you do not double count your inventory loss. For example, if something happened and your inventory just destroyed in a fire, and you calculated damages and included your inventory to the damages, you already claiming that loss via the casualty loss. You need to make sure that you do not include that loss in your cost of sales one more time. So you cannot claim your loss twice. And also, any insurance or other reimbursement you receive for a loss is taxable. So you need to make sure that you included the insurance proceeds. So you included your inventory in your costs, your losses, lost inventory on your costs, and you include the inventory proceeds into your revenues, into your income. You can choose to claim the losses separately as a casualty or theft loss. If you claim the loss separately, adjust opening inventory or purchases to eliminate the loss from items and avoid counting the loss twice. So that's very important here. You do not want to count the loss twice. Okay. There is a limitation on the size of YouTube message, 200 symbols. Okay, so loss of inventory. And what about net realizable value valuation? So net realizable value valuation, it's when you cannot, it's actually part of inventory standard. Let's go find it here. says 4 general principles applicable to the determination of the cost of inventories and subsequent measurement at lower of cost or market or lower of cost and net realizable value. So at the end of your accounting period, if you have inventories, you need to make sure that they are valued at the lower of cost or net realizable value. So cost is whatever you capitalized, and hopefully you capitalized everything correctly based on the inventory standard. It seems that my web camera doesn't work correctly. Let's see if I can change something here. Okay, so that's probably just give me a second. Okay. I found another camera. Okay. I have an issue with my streaming software. Hopefully it will respond in a few seconds. Sorry for that. Okay, so our inventory costing. IRS basically all of you to use the same principles as in inventory standard. Okay, I can make the picture smaller. So basically for your inventory valuation, IRS all of you to use a cost method, lower of cost or market method, or retail. And with your NRV adjustment, you can either apply the principles if your NRV, let's see where it is, LIFO, expenses, inventories, merchandise, LIFO, cost method. Okay, so you can use lower cost or market method for valuing your inventory for the IRS, and it basically allows you to apply to kind of impair your inventories at the end of the period. And when you impair your inventories, let's see. So let's say we calculated that amount based on costs 10,000, but then we say, okay, we cannot actually sell that quantity of inventories for 10,000. We can only sell it for 8,000. We need to provide net realizable value adjustment. And the moment you do that, your cost of goods sold for tax purposes increases. So basically you get to pay less taxes. And that's quite a good option. On the other hand, the lower cost or market method has limitations. If you use LIFO method, you cannot use lower cost or market method. You will have to use LIFO method adjustment. If you remember discussions from the previous module about FIFO and LIFO, so FIFO is first in, first out. Let's see if I can find it quickly. Okay, so here it is. FIFO, LIFO. So that's the exercises which we did on the previous module. So FIFO, first in, first out. First, you acquire some inventories, and when then you sell these inventories, you assume that you start selling the ones which you acquired the earliest. Usually, because of the inflation, the ones which you acquired earlier are the least expensive ones. And most of the companies use FIFO method, and FIFO is also allowed for IFRS, and LIFO is not allowed for IFRS, but US GAAP allows LIFO method. So under FIFO, your cost of inventory sold is usually the lowest because of inflation, because the inventories which you acquired the earliest are the cheapest one. Under LIFO, when you sell the inventories, you assume that you are selling the inventories which you acquired recently, and you do not, your oldest acquisitions just stay in your inventory. And under LIFO, your cost of goods sold is usually the highest because you are valuing inventories differently. You are valuing inventories at the oldest cost, which is usually the lowest. In our case, it was a bit vice versa, but in general, LIFO is usually the most cost-saving method. Not cost-saving, it is the most tax-saving method. So under LIFO, you will pay the least taxes, usually, until the moment when you liquidate all of your inventories. If you have zero, in the moment you sold the oldest inventories, the last inventories, you will have the biggest gain in tax and in accounting, and you will be taxed the most when you sold your kind of old inventory. But these are the methods, and they are allowed by IRS as well. But if you use LIFO, you are not allowed to use value inventory at the lower of cost or market. So in terms of net realizable value, depending on the situation why you are doing the provision, you might be able to deduct NRV provision for taxes, maybe with some differences. If you apply that method to value your inventory, but you need to use that method consistently. You cannot use one method in one period and other method in your other period. There is additional guidance regarding how you can use and how you can change inventory valuation methods. But that's it. You can adjust that. Okay, so we covered that. I copied all of that in the homework. So loss of inventory, lower cost or market method, goods that cannot be sold, and NRV is when you actually can sell the goods. You probably will sell them with some small loss. So NRV, you can use NRV when you apply lower cost or market method from the IRS, and you can deduct your inventory impairment. Okay, let's move on to our revenue exercises. Let's see, we did that. And for the revenue, we wanted to identify performance obligations. Oops. In our contract. We will not identify all of the obligations right now, and we will use the information from our example. Revenue SAS. Okay, here is a link to example and also to revenue guidance. It's called revenue from contract with customers. just in case. And in that example, let's scroll down. So we have an article here which describes the overall life cycle of the SaaS contract, and for our exercise, for our accounting memo, we pick up a SaaS contract. It's actually, we picked up the company which is selling QuickBooks, and we come up with some imaginary details of the contract. We have setup, service price, subscription price, support services, tax return warranty, and all of that has some standalone price. And all of that in our contract, all of that is sold by a bundle price of 6,000 for 2 years. And today we are going to look at one or two of performance obligations in that contract. Revenue recognition. Let me remind you that revenue recognition is like a five-step process. So first you identify the contract, then you identify performance obligations. Basically, performance obligations is what you promised to do in the contract. Then you determine transaction price, which is, in our case, it looks like this is the transaction price. It might be worded differently. It might be broken down by different stuff, by different pieces you have in contract. It might be just a total. So that's an example of transaction price. As to performance obligations, some of these items, some of our promises in the contract, some of the actions might be performance obligations, and some of them might not be performance obligations. So that's the trick here. And let's go back. So we determine the transaction price, then we allocate the transaction price to whatever we decide is a performance obligation. And then we recognize the revenue when we satisfy the performance obligations. So we did quite a bit of work around contract. There is a lot of guidance here. We did it last time. Today let's scroll down to performance obligations. Chapter 2. Okay. Contract term, combining contracts. It's hard not to have okay, identifying performance obligations. So performance obligations are the unit of accounting for purposes of applying the revenue standards, and they form a basis how the revenue is recognized. And we have, okay, they from the beginning they say as if we have immaterial promises, but let's find the definition. So promises in a contract can be explicit or implicit if the promises create a valid expectation that the reporting entity will provide a good or service based on the reporting entity customary business practices, published policies, or specific statements. It is therefore important to understand the reporting entity's policies and practice representations made during contract negotiations, marketing materials and business strategies, and so on. And promises might be about goods or servicing, another party to transfer shipping, standing ready to provide. So a lot of the stuff might be a promise in the contract, and some promises might not be included in the contract. So the situations might exist that there is no promise in the contract. However, based on the entity public statement or entity promises during the negotiation or entity customer business practice, you might want to account for some more promises than you actually see in the contract. So you need to know the context. In our case, we do not cover that. Maybe we will just imagine some tricky promise out of the scope of that example, but not now. And promise should somehow relate to goods or service. And if the promise is immaterial, then we can just skip it. We can just ignore it for the purposes of revenue recognition. Okay. At contract inception, an entity shall assess the goods or services promised in a contract with a customer and shall identify as a performance obligation each promise to transfer to the customer either a good or service that is distinct, a series of distinct goods or services that are substantially the same and that have the same pattern or transfer to customer. For the simplification reason, we can say that in our situation we just have a service or a series of service. So when we have a promise to transfer, when we have a performance obligation, we should have a promise to transfer good or service. And a series of distinct goods or services has the same pattern of transfer. So that's the definition when you have the series of goods or services. We might come back to that definition later, but now I want to find when we have a distinct, it is important to have a distinct good or service. And we have a distinct good or service when the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. And the entity promised to transfer the good or service to the customer is separately identifiable from other promises in the contract. That is, the promise to transfer the contract or service is distinct within the contract. So basically, to say that, obviously in our example, we have some promises here. We promise something to the customer. Set up his package, provide him services through subscription, provide him some support services, provide him some warranty, and that's basically it. These are our promises. Now we need to figure out if those promises are distinct from each other. So the customer should be able to benefit from this good or service on its own or together with other resources that are readily available for the customer. So your customer should be able to get some benefits from whatever we are selling him. And now we have setup cost here. Do we benefit from setup cost on its own? If we do not have a software yet, if we have not buy some license, if we have nothing to set up, it seems like we do not benefit. But if, for example, and it's we will look into that one more time. If, for example, we already subscribe to software, that's an interesting one. If we already subscribed to software and we have something to deal with, and we can use that software somehow independently, then we can buy that setup service. In that situation, that might be a separate service. In situation when we do not actually need it to start working in the software, and it can provide us some independent value. Okay, so let's now move on to our article. So we did that exercise, we did that example earlier. I will skip contract term for now. Okay, so here in the article, we have an example that will explain us the differences between performance obligation and setup activity or non-distinct performance obligation. Let's work in our memo at the same time. Revenue accounting memo. Okay, performance obligations. So here I have 5 steps. So where do I start? Let's start with the definitions. Of course, when we do a real memo, we need to consider more examples. And let's start with setup costs. What do we have in our example? Most SaaS arrangements involve more than one just hosting, allowing customer access to software solutions through web. Commonly, SaaS providers will also offer customers professional services, which may include configuration of the SaaS solution, interfacing the SaaS solution with the customer existing software, building customized reports, or many other types of value-adding services. When a customer contract includes professional services, it may be challenging to determine whether these services are performance obligations versus setup activities that are necessary for the SaaS provider to fulfill its promise in the contract. This distinction is important because it significantly affects the timing of revenue and cost recognition in the income statement, as shown in the following table. Okay. Professional service will be evaluated as a potential performance obligations if it transfers a good or service to the customer. The professional service might be distinct performance obligations if it meets both of the following criteria. The customer can benefit on its own. The promise to provide professional service is separately identifiable. So these are just the same criteria which we have just copied here. So that's from the standards. The first criterion is typically met when the SaaS provider or other regularly sell the professional service separately, without also requiring the customer to purchase the hosting services. Okay, so where is our memo? Let's start with our setup activity. So first, let's say capable of being distinct is distinct. Is it capable of being distinct? Is it sold separately from other promises in the contract? What else can we get from here? In some cases, the criterion can also be met even if the professional services is only sold in conjunction with hosted software, depending on the fact and circumstances. For example, if professional service will be provided after the hosting service have commenced, the customer can benefit from PS together with resources readily available to the customer, namely the hosting arrangements. So basically, what it says, if we are already using the solution, but we need some help to set up some features, that might be an additional service from which we can benefit separately. Let's say it's this way: if not sold do we buy it after we entered into hosting? So if it's not sold separately, if our company, QuickBooks, doesn't sell installation setup separately, it can still be a separate performance obligations in the contract, but only if we already gotten into the SaaS arrangement, into the hosting arrangement, and we need some additional services to set up some features, and we can benefit from that. We can benefit from that promise separately with available with our available resources. Let's see what we have here. With other resources that are readily available to the customer. So if we already entered into subscription, for example, and we do not let's call it, let's say no here, we do not know if they sell installation services separately, but let's say we say no here, and here what do we say? If we say yes, then might be performance obligation. If no, setup activity. Okay, so the objective of the second criterion is to assess whether the nature of the promise in the customer contract is to deliver professional services and other goods and services individually, or instead to transfer a combined item. Factors suggesting that the professional service is not separately identifiable from the hosting and other services is in the contract include professional service is an input necessary to fulfill a promise of delivering a combined output to customer. They are integral and they cannot be performed by someone else. The professional services significantly modifies or customizes the hosting solution, or vice versa. The professional services and other goods and services in the contract are highly interrelated or interdependent. That means that the SaaS provider would not be able to fulfill its contractual promise by transferring each of the goods or services independently. Okay, so is it capable of being distinct? And the second question is it distinct is it distinct within the context of the contract? And what option do we have here? So one is the service is integral and they cannot be performed by someone else. Oops. Setup service significantly modifies or customizes and the third one, service and other goods and services are highly interrelated and interdependent. Not be able to fulfill So if we answer yes to the below questions, it is more likely that our setup costs are not distinct, and therefore they will not be a part of our promises. That will not be a part of our performance obligations to which we allocate the revenue. And basically what we have here is setup service is integral, and the third one, setup, let me change it to setup. So if, for example, we say we sell QuickBooks, and part of that QuickBooks is a setup service, and if, for example, there is no way to avoid that setup service, so it's unavoidable. If that service cannot be performed by someone else, or if that service is if you have some SaaS service, but your setup service modifies your SaaS service significantly, then you might not have a separate performance obligation. I know that might sound a bit complicated. So we have identified the contract here, identify performance obligation. So what we are working on is to figure out how do we allocate contract price, $6,000, which we pay upfront for 2 years. Do we need to recognize a separate revenue for setup service, subscription service, support service, because the pattern of consumption of every of that promise is different, and or do we need to just ignore setup service and allocate all 6,000 for 2 years. So that's what we're trying to figure out. And depending on the answers on these questions, so depending on the answers on these questions, if we say that no, it cannot be sold separately, that service cannot be sold separately, and no, we bought it as a bundle, we do not buy it after we subscribed, then it would be setup activity. Then also, if we say yes, that this setup service is integral and it cannot be performed by someone else, and also it significantly modifies the hosting solution, and basically it is undistinguishable, it is inseparable from our package, then we can conclude that it is not a performance obligation. So let's come back to our article and see what we have here for setup activity and non-distinct performance obligation. If professional services does not meet the criteria to be a separate performance obligation, SaaS providers should consider whether activities are items that the entity must undertake to fulfill a contract. Setup activities. Setup activities do not transfer a good or service to a customer. For example, a SaaS provider might need to perform various administrative tasks to configure a cloud-based platform for use by a customer. The SaaS provider might even charge the customer an activation or similar fee to recover the cost of performing the task. However, the performance of the task does not transfer good or service to the customer. Therefore, setup activities cannot be considered performance obligations. And let's see the accounting treatment. If professional service is considered to be a distinct performance obligation, portion of the transaction price will be allocated to the professional service based on standalone sales price and recognized as a revenue when or as a professional service is transferred to the customer. If cost of fulfilling professional service are incurred prior to the transfer of the professional service to the customer, such costs will typically be deferred. Once transfer of control of the professional service begins, any cost previously deferred as fulfillment costs should be recognized on a systematic basis that is consistent with the transferred goods and services to which the assets relates. Any fees charged to the customer for the setup activities are allocated to other performance obligations in the contract and recognized as revenue with those performance obligations. That is, no revenue is recognized upon completion of the setup activities. So our question was, we got 6,000 here. Our customer pays us upfront 6,000 here. And we have some allocation of these cost of that price, but it doesn't match the 6,000 exactly. And our question was, do we recognize any revenue when we complete setup activities? And the answer is, let's say it here. because you see, that is a 6,000 revenue for 2 years. And based on all what we know about accrual basis, some of these 6,000 should be spread over 2 years. Now the setup service take place in like day 1 or month 1, and by value it should take a significant part of these 6,000. So management and we can be interested in recognizing the revenue as early as possible, and that's why we are asking that question. And so do we recognize any revenue at all when we complete such activities? Yes, if setup is a separate performance obligation. No, if setup is not SPO, but merely, let's use a term from the article. Let's just copy it from here. No, but merely setup activity and non-distinct performance obligation. Okay, so we need to answer yes for that part. If yes, then it is more likely separate performance obligation. More likely not. Yeah, it is a lot of confusion here, because the first one should be yes, the second one should be no. Okay. If we conclude that our setup cost is SPO, we recognize some part allocated of contract cost when we complete, let's say, when we satisfy that if not, we do not allocate contract. Okay, let's come back here. So we identified the contract here, and we have transaction price. That's step 3. Now we are just identifying performance obligation. So the correct term would be transaction price. If we conclude that our setup cost is separate performance obligation, we recognize some part of transaction price. We do not allocate transaction price to set up cost. Let's say, so what can we do here? Let's say we will complicate setup service let's say we did analysis, and based on our analysis we concluded that setup consists of two parts. One, setup required. Let's just take the wording from here. Okay. Setup necessary to fulfill a promise. And let's just divide the cost equally. And second, optional setup to add some additional fun. So basically, I mean, I totally made it up, but to make our task more interesting, we did an analysis of setup cost for that SaaS contract, and we considered why when it can be a separate performance obligation, when we recognize revenue based on in the moment when we did that setup. And these are the criteria. So first, it should be capable of being distinct. So if it is sold separately from other promises, or if it is not sold separately, but we can buy it after we enter it into hosting arrangement, and we can start work with our service. When the customer can start work with the service which they purchased from us without that setup. And to make everything more interesting, I specified that our setup costs consists of two parts. The one is kind of required to make everything works. And the other one is just some add-on services which adds additional functionality to the package, and we can live without that functionality, and that's also sold separately. So we concluded that we have one separate performance obligation, and one part of that is not SPO. Now, based on the same discussion, we can conclude that subscription, the access itself to the service, is probably SPO. It will all depend on the facts and circumstances. and support services is also SPO. On the other hand, our the pattern of consumption of both of these, it will most likely be the same, so there is not much sense in separating the two. Okay, do we have anything else? And we have tax return warranty, and I will need to check a guidance on that. So for today, we did that analysis in respect of setup costs. We tried to answer the questions from the guidance about whether something is distinct or not, and whether the promise to the customer, whether performance obligation is distinct or not. If it is distinct, then some of the contract consideration should be allocated to it. If it is not distinct, no consideration should be allocated to it. No, what term do we use here? Transaction price. Yes. Transaction price. So contract consideration, transaction price, that's our 6,000 here. And we concluded that, I mean, we made it up totally, that in what we have listed as a setup service cost, we actually have two components, one of which is necessary to make everything running. So we will not be able to sell our SaaS service without that setup. And the other one is optional. And we also have these two here. We can take a look. So if we sell support services separately, and if they provide some additional value for us, and if they can be performed by someone else here, then we can probably conclude that these are like a separate performance obligation. So maybe, so if we can use basically subscription without these services, and if we buy these services that they provide value for us, then these are SPO too. Okay, for today I will conclude. We used 1 hour 40 minutes, quite a big time. Regarding the Russian language session, if you want one in the Russian language, can you send me an individual message for tomorrow? Because I see that there is not much attendance for the Russian speaking session. As for today, thank you for coming. Hopefully you get some value from today, and let's see each other next time. I will let you know when I schedule the Saturday Q&A and lecture. Thank you. Bye bye.